If a recession started tomorrow morning, like a real grinding economic halt, what would you actually want to see sitting behind the bonds you own?
You'd want cash, obviously.
Yeah.
You'd want dependable earnings. But more than anything, you would want a big, boring cushion of value, something that can take a hit without breaking the promise to the bondholder.
Right. And that cushion is our topic today. Welcome to Capital Allocation LabCom, audio first lessons that turn classic investing ideas into practical decisions for long-term owners.
And if you like this style, no hype, no trading signals, please subscribe. And if today's episode helps you think more clearly about bonds and balance sheets, hit like. It's a small action that really keeps the channel growing.
So today we're continuing our walk through security analysis. This is an incredible book, and we're on episode 11 of this deep dive into the source material.
Yeah.
We're finishing up the chapter on specific standards for bond investment, and specifically we're looking at the relationship between stock capitalization and bonded debt.
Right. Which, just to provide a translation here, we're talking about the equity behind the bonds. We're basically asking how much junior capital is there to absorb losses before the bondholders are actually in trouble.
Exactly. And as always, just a quick reminder, this is educational content only. It is not individualized investment, legal, tax, or accounting advice.
Right. So, all right, let's build the intuition first. Then we'll lay out the concrete tests that Graham and Dog propose in the text. And finally, we'll translate those tests into a modern checklist you can actually use.
That sounds perfect. Let's start with a small mental model. Just to get our bearings, imagine a company as a house.
Here we go. The mortgage analogy time.
Yes.
It's the best place to start on that.
It's a classic for a reason, right? I mean, if you lend someone money secured by a house, essentially, if you hold the mortgage, you want the house to be worth comfortably more than the loan.
Right.
You don't want it to be exactly equal. You want it to be worth more.
Yeah, because if things go wrong, if the borrower stops paying and you actually have to foreclose and sell the property, you're almost never selling at a perfect price.
Never.
You're paying legal fees, you're paying agent fees, and you're likely selling under stress. Or, just in a really bad market.
Exactly. And that gap, that space between the value of the property and the amount of the debt is the lender's margin of safety. And bond investors are, at the end of the day, lenders.
Right.
It is a totally different contract than a home mortgage, obviously, but it is the exact same posture. You need a buffer.
You do. And the chapter actually starts by pointing out something basic, but really easy to forget. The stock and surplus that sit behind a bond issue, they basically express the same fact as the excess of resources over indebtedness.
So in other words, if you're looking at a balance sheet, you can describe this safety cushion in two completely equivalent ways.
Yeah. One way is to look at net assets versus bonded debt. The other way is to look at stockholders' equity versus bonded debt. It is the exact same picture, just viewed from two different angles.
Right. So let's visualize the condensed, the typical balance sheet the chapter uses to prove this point. Imagine a company with net assets, and by that we mean total assets minus current liabilities of $1 million.
Okay, $1 million. And against that, let's say they have bonded debt of $600,000.
Which leaves stock and surplus the equity of $400,000.
So the basic identity here is just simple arithmetic, right?
Right.
Net assets equals bonded debt plus stockholders' equity. 1 million equals 600,000 plus 400,000.
Right. Now, why does this matter? Because bondholders don't just care about whether the interest is getting paid today. They care about the underlying economic strength of the enterprise that's behind the contract.
And that strength is partly captured by the idea that the business is simply worth a lot more than it owes.
Exactly. A bond is a fixed claim. So if the business value falls, the equity gets hit first.
Yeah.
Equity is the shock absorber. If the value of the company drops from $1 million to $800,000, the bondholders are still fully covered. The equity holders took the loss.
So when we say equity cushion, we're not just being poetic. We literally mean there is junior capital that must be completely wiped out before the bond principal is impaired.
Right. Now, there's a little algebra here that makes this tangible. Stockholders' equity is simply net assets minus bonded debt.
But the chapter also frames it as a ratio relationship. If you divide net assets by bonded debt, you're measuring how much asset coverage there is per dollar of bonds.
So in our simple example, net assets of $1 million divided by bonded debt of $600,000 equals about 1.67.
Meaning, for every dollar of bonded debt, there are about $1.67 of net assets backing it up.
And that obviously implies equity is the remainder. So if we look at the equity side, equity is 400,000. Is that 2/3 of the bonded debt?
Well, careful with the exact math here. If you take 400,000 in equity and divide it by 600,000 in debt, that equals 0.666.
Right.
So yes, equity is about 2/3 of the bonded debt. Another way to say it is that bonds are 60% of net assets and equity is 40% of net assets.
That's a great catch. And it's worth going slowly here because these ratios show up in the standards we're about to discuss. Saying bonds are 60% of the capital structure is the exact mathematical equivalent of saying equity is 2/3 of the debt.
Yeah. And then the chapter brings in a really practical reference point. It looks at the investment rules used by New York savings banks.
Right.
These were historically very, very conservative institutions.
Super conservative. Specifically, these were rules for investing in public utility bonds. And the law actually uses two approaches to ensure safety.
Right, so requirement one is property-based. It says that the mortgage debt, plus all underlying mortgage debt, shouldn't exceed 60% of the value of the mortgaged property.
Okay, so if you have a utility with mortgage property valued at $10 million, the total mortgage debt shouldn't exceed $6 million.
That's the 60% ceiling, which also means the property value is at least 1.67 times the mortgage debt, since 10 divided by 6 is 1.67.
All right. And then requirement two is equity-based. It says that the capital stock should be equal to at least 2/3 of the mortgage debt.
So if mortgage debt is $6 million, capital stock must be at least $4 million.
And here's the key point. In a simple balance sheet with only mortgage debt and equity, those two requirements are broadly equivalent. They're basically saying the exact same thing.
Yeah, because 60% debt and 40% equity translates into equity being 2/3 of debt.
Right.
If debt is 60 and equity is 40, then equity divided by debt is 40 over 60, which is 0.666, or 2/3.
So far, so tidy. But then the chapter makes a really important point. Complications arise when there's substantial unsecured indebtedness.
Yes.
This is where the simple property test can actually fail you.
Right, because you can totally meet the property test and still have a really weak equity cushion if there's additional debt sitting ahead of the equity,
Yeah.
but it's just not captured by the mortgage ratio.
Right. And the chapter gives an illustrative example that really clarifies this perfectly. Imagine a company where the mortgaged property is $10 million and working capital is $1 million. So total assets are $11 million.
Okay, and let's say the mortgage debt is $6 million. So if you just run the property test, $6 million debt on $10 million property is exactly 60%. You pass the test.
You pass, but then you look a little closer and you see the company also has $3 million of debentures.
Right, and debentures are unsecured debt. They don't have a claim on the specific property, but they absolutely still sit ahead of the equity in the line for payout.
So you have $6 million mortgage, $3 million debentures. Total debt is $9 million. And total assets are $11 million. That leaves stock and surplus of only $2 million.
Now look at equity relative to the mortgage debt.
Mm.
Equity is $2 million, mortgage debt is $6 million. $2 million is only 1/3 of $6 million.
Right.
Which is not the required 2/3.
Yeah. So you pass test 1, the property limit, but you totally fail test 2, the equity ratio. And that second requirement is doing real heavy lifting work there. It prevents you from just ignoring other debt that erodes the cushion.
This is one of those great moments where a simple rule actually teaches a deep habit. When you analyze bonds, you can't just look at one ratio in isolation.
No, you have to ask what else is in the capital structure. Debt can hide in layers. Just because your bond is secured doesn't mean the company is healthy if there is a massive mountain of unsecured debt piled on top of it.
Right, so the modern translation here is, don't just look at secured debt against specific assets. You have to look at total obligations that have a prior claim.
Like unsecured bonds, term loans.
Revolvers, leases, pension deficits, any guarantees.
Exactly. The chapter's example uses debentures because, that was a common structure then. But today, we'd broaden the lens to include all those liabilities you just mentioned.
And the chapter then adds a detail that sounds technical, but it really matters.
Mm-hmm.
The old New York statute looked only at the par or stated value of stock.
Right. It didn't give any credit for book surplus, even though surplus is definitely part of stockholders' equity.
Yeah, and the reasoning there is purely legal. Surplus might be distributable to stockholders. The company could just decide tomorrow to pay out that surplus as a dividend, so it's not actually guaranteed to remain as protection for the bondholders.
But Graham and Dodd point out a practical counterpoint to that, especially for utilities. Utility surplus is often invested in fixed assets like power plants, transmission lines, and it just isn't realistically distributable in cash.
So their point is, if you're going to use an equity test, using stock plus surplus might be more logical than just using par value alone. The money is literally trapped in the business protecting you.
But this raises a much deeper question, though. What kind of equity is actually protective?
Right, because a balance sheet equity number can be, well,
Very squishy.
it can be reduced by write-downs or boosted by aggressive accounting choices or just filled with assets that aren't easily monetized.
Which is exactly why the chapter is skeptical about leaning too heavily on balance sheet property values, especially for utilities.
Because utilities have their own unique valuation complexity, right?
Yeah.
They have regulatory rate bases, allowed returns, and asset values that are tied to commission decisions.
Yeah. Even today, you can't just assume a utility's fixed assets are worth their book value in a liquidation sense. But for a going concern, regulated assets can be quite stable.
So the chapter's position is really nuanced. It's not just saying ignore equity. It's saying be careful about what your equity number actually represents.
And keep coming back to the fundamental economic question. Is the business as a whole worth far more than it owes?
The chapter makes a pretty strong statement here. It says that for public utility bonds, property or stock issue tests often don't tell you much that you can't already see in the earnings record.
Which brings us to earnings coverage. How many times earnings cover interest? That became the dominant quantitative test for bond selection for a very good reason.
Because it connects directly to going concern value. If a business consistently generates earnings well above its interest expense, it can service debt, it can refinance, and it retains its value.
And in many cases, that's the absolute heart of bond safety, cash flow stability. If the cash is there, the bond is usually fine.
But the chapter warns against oversimplification here. Reducing bond safety to a single criterion like earnings coverage can be really dangerous.
Because earnings in the specific period you examine might be completely non-representative.
Yeah, they might reflect temporary boom conditions or temporary distress. Or they might be presented in a way that just doesn't reflect true income.
That word presented is doing a lot of heavy lifting there. Accounting can absolutely flatter coverage.
Especially for industrial companies, where supervision and standardization historically were much weaker than in railroads and utilities.
Right. And in modern language, we'd say industrials can have far more cyclical earnings, they have more discretion over adjustments, and they generally have more incentives to show smooth performance.
So the chapter argues that, at least for industrial bonds, you really need a second quantitative test. You need a completely different lens on the exact same safety question.
In other words, if you only check whether interest is covered, you might completely miss whether the business has a robust equity cushion behind the bonds.
And that's where we finally arrive at the central innovation of the second half of this chapter.
Right. Graham and Dodd propose a supplemental test. They say, measure stockholders' equity not by book value, but by market value.
This is a huge pivot. Specifically, they say to compare the market value of the capital stock to the total funded debt.
Now, there's an immediate objection here. Stock prices are volatile, they're emotional, they're sometimes totally detached from intrinsic value. So why use a volatile number to measure safety?
The authors basically agree with that premise, and yet they still proceed.
Because for this restricted purpose, just estimating whether a substantial equity exists behind the bond issue market value can actually be a better rough index than balance sheet figures.
Here's the subtlety of their argument. They're not saying the market price is always right.
Yeah.
They're saying it's a clue to what the market thinks the enterprise is worth as a going concern. It is literally the vote of the people who own the risk.
And if the market value of equity is many times the debt, that's incredibly strong reassurance. But if it's tiny, that's a massive warning flare.
Right. Think of it like this. A bondholder wants a buffer. Book equity might be inflated by assets carried at totally optimistic values that just haven't been written down yet. But market equity, despite its mood swings, often reacts very quickly to deteriorating prospects.
In extreme cases, it's really hard to argue with. I mean, if a company's equity is worth 10 times the debt in the market, the bondholders have a huge junior layer.
And if equity is worth, say, 10 cents on the dollar of debt, the market is screaming something about risk. The market is saying, we don't think there is much value here.
Again, it's not always completely accurate, but as a screening device, it matters a lot.
So the chapter recommends making this calculation a standard element of bond selection. especially for industrial issues, and they suggest setting minimum requirements.
Which brings up the big question. What minimum requirements, what number should we actually look for?
The chapter admits right away that it's really hard to answer from experience alone, simply because stock prices change a lot and companies differ so much.
So instead, they build a theoretical rule of thumb, and it rests on assumptions about what stock investors should earn relative to bond investors.
The general idea is utility and railroad stocks might be expected to earn about 1.5 times the percentage yield of their bonds.
And industrial stocks might be expected to earn about twice the percentage yield of their bonds.
And from those assumptions, they derive a relationship between minimum interest coverage and minimum stock-to-bond value ratios.
Let's state these minimums really clearly because we'll keep returning to them. These are the main all guideposts.
Okay. For public utilities, a minimum interest coverage of 1.75 times fixed charges, and a minimum stock market value of 50% of bonded debt.
Said another way, at least $1 of stock value for every $2 of bonds.
For railroads, a minimum interest coverage of 2 times, and a minimum stock market value of about 2/3 of bonded debt.
So $1 of stock value for every $1.50 of bonds.
And for industrials, a minimum interest coverage of 3 times, and a minimum stock market value equal to 100% of bonded debt.
$1 of stock value for every $1 of bonds.
Notice the clear progression there. Industrials require the highest coverage and the highest equity ratio.
Now, listeners might ask a fair question. Why not just use one test? Why do we need the market value test if we already have the coverage test?
Because in real life, the two tests just don't always agree. Interest coverage can look perfectly fine while market equity is dangerously thin, or coverage can look mediocre while equity is massive.
The chapter argues you need both because each one catches entirely different failure modes.
The earnings test, the coverage tells you, can the company actually pay interest out of its operations?
Right. Well, the stock value test tells you, does the market actually believe there's a substantial junior cushion and economic buffer behind the debt?
And using the two together reduces the chance that you're just fooling yourself with a single rosy metric.
The chapter actually includes a really interesting summarized exhibit from 1938 to illustrate these exact relationships.
Yeah, it shows a public utility, a railroad, and an industrial company.
The companies are North American Company, Union Pacific, and United Biscuit Company of America.
Okay, so for the utility North American company, the times earned figure is about 1.67. The stock-to-bonds ratio is about 0.51 to 1, so it barely meets the utility standards.
Right. And for Union Pacific, the railroad, times earned is about 2.31, and stock to bonds is about 0.85 to 1. It's comfortably above the railroad standards.
And then for United Biscuit, the industrial, times earned is about 4.47, and stock to bonds is about 1.45 to 1.
Now, the point isn't that these are perfect, flawless specimens.
No, the point is that the broad pattern holds true across sectors. Industrial firms need stronger coverage, and they typically show higher equity value relative to debt, just reflecting their inherently riskier earnings. United Biscuit needs that 1.45 to 1 ratio because its business is just way more volatile than North American company's utility business.
Today, if you did this exercise, you might use market capitalization for common equity, add the market value of preferred, and then compare that to total funded debt.
But the spirit of it remains exactly the same. Is the equity layer big enough that bondholders are not just perched directly over the abyss?
Let's actually pause and make this operational for someone listening right now who wants to apply it.
That's a great idea, because stock value to debt can sound a bit abstract until you actually sit down and do it once.
Step 1. Define the debt you care about. In the chapter's language, funded debt is essentially longer-term debt, so bonds, debentures, and similar obligations.
In modern financial statements, you'd start with total long-term debt and add any short-term borrowings that are effectively part of the capital structure, like a revolving credit facility that's routinely drawn.
Then step 2. Define the equity layer. For market value, you'd use market cap for common stock and add the market value of preferred shares if they exist.
Right. And if there are publicly traded preferreds, finding their market value is relatively straightforward. If not, you might have to approximate it from book and yield, but that can get pretty messy.
Step 3. Compute the ratio. Equity market value divided by funded debt.
If that ratio is high, say 2.0, then equity value is twice the debt, and bondholders have a really sizable junior buffer.
But if it's low, say 0.2 equity value is only 20% of debt. That's very thin, and it should absolutely trigger skepticism.
Then step 4. Don't stop there. You have to ask what's missing from that debt number.
This is really where modern analysis adds crucial layers. Leases can behave like debt. Pension obligations can behave like debt. Guarantees can behave like debt.
The chapter actually hints at this when it mentions that railroads and utilities can have complications, things like rental obligations that are equivalent to debt, and preferred stocks of subsidiaries that rank ahead of parent company bonds.
Exactly. The capital structure is rarely just a neat, simple stack. It can be a complete maze.
So the ratio is a starting point, not an ending point.
But it is a very powerful starting point. It forces you to look at the junior capital as a true buffer, not just as a lottery ticket.
The chapter then includes this fascinating nuance about income bonds. This is really interesting for understanding how hard or soft a claim actually is.
Right, so income bonds are a form of debt where the interest is not a fixed charge. It's paid only if it's earned.
And the chapter points out, if interest on income bonds isn't fixed, you don't include it in fixed charges for your coverage calculations.
Similarly, the principal amount of those income bonds shouldn't be treated the same way as fixed funded debt when you're comparing it to stock equity.
In fact, junior income bonds of long maturity are so close in character to preferred stock that their market value can actually be considered part of the equity cushion protecting the fixed interest bonds.
This is a huge conceptual point. Not all obligations are equal in their hardness.
Some claims are contractually flexible. They absorb stress exactly like equity does.
The chapter's example here is Colorado Fuel and Iron. There are first mortgage 5s due 1943. Those are the senior fixed interest bonds.
And behind them sits a junior layer. But instead of just stock, this layer includes a junior income bond issue plus common equity and warrants.
So the market value of that income bond and stock equity is added all together as a single protective layer.
Let's read the exact numbers on this one. The income bonds are valued around $4.966 million, common stock around $7.05 million, and warrants around $1.339 million.
So the total equity-like layer is about $13.355 million.
Against senior bonds outstanding of about $4.483 million.
So the equity-like cushion is roughly 13.355 divided by 4.483, which is about 2.98 times.
Nearly $3 of junior value for every dollar of senior bonds.
And the chapter notes something really dramatic about this. Prior to a reorganization, those senior bonds had been followed by a large fixed interest bond issue. And the requirements of that fixed debt precipitated a receivership in 1933. The senior bonds actually sold as low as 30.
So restructuring the junior claim from hard fixed interest debt to soft income bond-like equity completely changed the technical position of the senior bonds. It just made them fundamentally safer.
The modern translation here is critical. When you analyze a capital structure, you must distinguish between fixed obligations and contingent obligations.
Your preferred stock with optional dividends, that's more equity-like. Subordinated debt with payment-in-kind toggles, somewhere in between. Leases, usually quite debt-like.
The protective cushion behind your bond depends on the actual hardness of the claims ahead of equity, not just their labels.
Labels are just marketing. Contracts are reality.
Now we get to a very practical section. How do we interpret cases where the earnings test and the stock value test point in totally different directions?
Right. If the two always matched, we'd only need one test. But they don't. Sometimes they fight each other.
First case. The earnings picture is not completely convincing, but the stock value ratio is considerably higher than the minimum.
The chapter references a prior example for this, Fairbanks-Morse. At the low stock price in 1938, the stock equity ratio was more than 2 to 1. That's about $12 million in stock value, sitting behind $5.6 million of bonds.
And that kind of massive buffer might totally dispel any doubt arising from a weak average earnings figure.
Because it suggests the broader market strongly believes the enterprise has meaningful value beyond the debt, even if the current earnings are temporarily soft or noisy.
Second case. Interest coverage seems perfectly satisfactory, but the stock value ratio is substantially below the minimum.
And this is exactly where Graham and Dodd become especially cautious. They give two contrasting examples here.
One in the absolute depths of depression and one at the peak of a recovery.
Let's do the depression example first because it perfectly teaches the negative art mindset that they emphasize.
Right. The example is inland steel 4.5s due far in the future, selling at 82 in September 1932, yielding about 5.6%.
The key data point here is that the issue met the earnings test based on an average, but it failed the stock ratio test.
So investors might reason. Inland is a really strong company, the depression numbers are abnormal, and the bond actually looks attractive at 82.
And historically, it did work out. The bonds were called at a premium in 1936.
But the chapter's critique is strictly about the logic at the exact time of purchase.
The weakness in the reasoning is that it requires making assumptions about the future that really shouldn't be needed to justify an investment-grade bond purchase.
Specifically, it implies you're betting not just that the bad conditions are temporary, but that the common stock is actively undervalued.
Right, because if the equity market value is low relative to debt, the market is expressly not granting you the substantial equity cushion the bond buyer relies on.
And the chapter makes a hard rule of thumb point here. No bond investment should be made if it requires assuming the common stock is selling too low.
If you're right that the stock is undervalued, then the stock is likely the better purchase anyway.
And if you're wrong, your bond purchase may not actually be safe at all.
The chapter really drives this point home by comparing inland steel to crucible steel at the exact same time.
Crucible Steel 5s due 1940 sold around 60, yielding about 13.4%.
Interestingly, the exhibit suggests both earnings coverage and the stock value ratio were actually better for Crucible than for inland.
Yet the yield on Crucible's bonds was about twice as high, implying the market demanded far more compensation for the perceived risk.
So to prefer inland's bonds over Crucible's, you'd have to assume inland stock was much too low and Crucible stock was much too high.
That is a very complicated chain of assumptions for what is supposed to be a straightforward, safe bond investment.
Again, bond investing, in their view, is a negative art. It's about avoiding trouble more than finding brilliance.
The point isn't that inland was a bad investment. Obviously, it wasn't.
The point is that a logical examination at the time wouldn't give you a clean yes, especially when other alternatives exist.
Modern translation. When you're buying bonds at prices that imply they are high grade, don't justify them by saying the equity is mispriced.
That's a stock investor's argument. Bond investors want robustness without needing heroic assumptions.
Now let's look at the opposite type of illustration. Brooklyn-Manhattan Transit 4.5s due 1966.
Okay. In January 1937, they sold at 104, yielding about 4.27%.
And the earnings coverage was about adequate by the minimum standard for railroad bonds?
But the stock value ratio was just ugly. Less than 40 cents of stock value for each dollar of bonds.
Meaning, even in a genuinely strong market environment, the equity cushion was incredibly thin.
And the chapter interprets this as the stock market simply not being sufficiently optimistic about the company's future prospects.
So a bond buyer looking for a safe 4.25% would have been wise to take that deficiency as a huge hint to look elsewhere.
Then the chapter adds a total gut punch. By December of that same year, the bonds had fallen to 44.
That's not a gentle reminder from the market, that's a crater.
Yeah. And the chapter offers an additional insight here. The stock value test isn't just purely quantitative, it's partly qualitative too.
Because it reflects the market's collective, real-time appraisal of prospects and risks.
And in this specific case, it may also have signaled deep concerns about accounting quality.
The offering prospectus actually showed a wide difference between depreciation and amortization charges reported to security holders and those taken on income tax returns.
And using the more conservative depreciation numbers would have reduced coverage below the suggested minimum.
So the market equity test really did three things here. It measured the actual cushion, it reflected skepticism about future prospects, and it strongly hinted that reported earnings might be flattering the reality.
Modern translation. If the equity market is pricing the business as fragile and your bond thesis rests heavily on adjusted earnings, you need to be extremely careful.
Especially if the bond yield is investment grade-like, but the equity is priced like a distress option.
That mismatch is almost always a warning, not a bargain.
It might be telling you that something in the earnings story is just not durable.
The chapter then notes some practical complications for railroads and public utilities.
In industrial companies, stock value to funded debt is often super easy to compute.
But for railroads and utilities, you might really need to consider obligations that are not captured neatly in the bonded debt line item.
Rental obligations that are equivalent to debt, for example.
Or preferred stocks of subsidiaries that actually rank ahead of the parent company's bonds.
In other words, structural subordination and hidden fixed charges.
These difficulties definitely make the stock value test harder. But Graham and Dodd still argue that careful investors should absolutely apply it in those fields too.
They even foreshadow that in the next chapter, the stock value test would have helped investors avoid purchasing many railroad bonds at high prices during 1935 to 1937.
And they mention a specific method for this, capitalizing the fixed charges to estimate total debt when the balance sheet just doesn't tell the whole story.
Today, you might think of this as converting lease payments into debt equivalents, Or capitalizing long-term fixed obligations to understand the true total leverage.
The underlying habit is exactly the same. If an obligation is fixed and senior, treat it as debt-like, even if it's not conveniently labeled bond.
And if you can't compute the exact ratio cleanly, you can usually still get a range. And ranges are often enough to avoid the really obvious mistakes.
Now we reach a deceptively important question. Should the required stock value ratio change with market conditions?
Intuitively, it seems like it probably should, right? In a boom, you might demand more equity value behind your bond. In a depression, you might accept less because all prices are naturally depressed.
The chapter explores that idea in depth and then totally rejects it as impractical.
For two main reasons. First, it assumes bond buyers can reliably recognize when stock prices are objectively too high or too low.
That's a very flattering assumption and usually a false one.
Second, it would actively require bond investors to act with special caution when times are booming and with immense confidence when times are hard.
That's a counsel of perfection. Human nature tends to do the exact opposite.
Right. People feel safest when prices are high and scariest when prices are low.
The chapter's conclusion is basically, don't build a rule that entirely depends on you being a perfect market timer.
They say they won't propose a rule demanding a larger stock value ratio in a boom because realistically it just won't be followed.
They do add a personal note, though. If you're personally convinced that stock prices are dangerously high, you'd be wise to insist on stock equity coverage well above the minimum.
And they also won't propose the opposite relaxation in bear markets because by diligent search, you can still find investments that meet normal tests even in deeply depressed conditions.
So the modern translation is, build a framework that you can actually apply consistently.
Consistency is a risk management tool in itself.
And if you have a strong conviction about extreme valuation, you can tighten standards. But that's an overlay. It's not the core rule.
Let's pause on that phrase again. Bond investment is a negative art.
Meaning, success comes much more from avoiding disasters than from finding home runs.
You're not trying to prove that a bond will perform brilliantly.
You're just trying to ensure it won't perform disastrously.
That implies two very practical behaviors.
First, you want your bond thesis to rest on solid facts that simply don't require optimism.
Second, you want your quantitative tests to capture different kinds of risk, not just measure the exact same risk twice.
That's exactly why the chapter insists that relying on earnings coverage alone is way too simple.
Coverage can be managed with accounting. Coverage can look amazing in a cyclical peak. Coverage can hide deep structural fragility.
The equity market value test can definitely also be wrong, but it often reacts to fragility way earlier than debt investors do.
Especially because equity is the first loss piece. It's the canary in the coal mine.
In modern markets, think about a company whose bonds trade near par with a really modest spread, while the stock completely collapses.
That's often a glaring sign that bond investors are just anchored to historical ratings or index weights, while equity investors are aggressively pricing in fresh trouble.
Sometimes equity is overly pessimistic, sure, but sometimes it's simply ahead of the curve.
The chapter's framework says, don't ignore that signal, measure it, put it directly into your process.
Not as an oracle, as a clue.
And as a discipline that keeps you from making complicated bets when you actually think you're making simple investments.
The chapter closes with a summary of minimum quantitative requirements suggested for fixed value investment.
This is basically like a checklist. It's not the whole story, but it's a very strong starting structure.
Requirement 1, size of obligor.
For municipalities,
Yeah.
a minimum population of 10,000.
For public utilities, gross revenues of at least $2 million.
For railroads,
Yeah.
gross revenues of at least $3 million.
And for industrials, gross revenues of at least $5 million.
The spirit of this rule is simple. Smaller obligors are just inherently more fragile. Size is a crude but useful proxy for stability and access to capital.
Requirement 2, interest coverage.
For public utility bonds, a 7-year average coverage of at least 1 3/4 times.
For railroad bonds, a 7-year average coverage of at least 2 times.
For industrial bonds, a 7-year average coverage of at least 3 times.
For real estate bonds, a dependable estimate of coverage at least 2 times.
Requirement 3, value of property.
For real estate bonds, the fair value of property must be 50% more than the bond issue based on actual sales in a non-inflated market.
For investment trust bonds, a similar ratio using the market value of assets.
Requirement 4, market value of stock issues.
For public utilities, stock value at least 50% of bonded debt.
For railroads, Stock value at least about 56 and 2/3% of bonded debt.
For industrials, stock value at least 100% of bonded debt.
This last requirement is really the big takeaway of today's episode. Don't forget to measure the junior capital protecting you.
And don't confuse book protection with real economic protection. You have to use multiple lenses.
Let's end the main lesson by turning the chapter into a simple procedure.
A bond selection routine you could probably run in an hour on most companies.
Step 1. Identify the obligor and its scale. Is it a substantial enterprise with truly durable revenue?
Step 2. Compute interest coverage on a multi-year average, preferably through a full economic cycle, and be conservative about what actually counts as earnings.
Step 3. Map the capital structure. List all funded debt and debt-like obligations that are senior to the equity.
Step 4. Compute the market value of junior capital. That's market cap plus any preferred at market value.
Step 5. Compute the stock value ratio. Equity market value divided by funded debt.
Step 6. Compare that to a minimum that matches the business type. More cyclical and less regulated businesses should absolutely demand a higher cushion.
Step 7. If the coverage looks fine but the equity cushion is thin, treat that as a flashing reason to dig deeper, not as a reason to declare victory.
Ask what the equity market is actually afraid of. Is it business model pressure, regulatory risk, hidden leverage, massive refinancing walls, litigation, or bad accounting quality?
Step 8. If the equity cushion is huge but coverage is mediocre, ask whether earnings are temporarily depressed or just reported in a very conservative way, or whether the market is simply way too optimistic.
And step 9. Avoid any bond investment that requires you to actively say, I'm sure the stock is undervalued.
If your edge is equity valuation, then buy equity. Bonds should only be bought when safety is completely evident without heroics.
That's the negative art. It's not glamorous, but it's highly durable.
And for long-term investors, durability is exactly the point.
That's our deep dive on the equity cushion behind bonds, the relationship between stock capitalization and bonded debt, and why the market value of equity can be such a vital secondary test.
Capital Allocation Lab exists to teach disciplined, long-term investing by revisiting classic books and core ideas, explained clearly in today's context and audio-first episodes you can learn from any day you choose.
Thanks for joining. If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.
And tell us what you want next. Drop a comment with your questions, your favorite fundamental investing concept, or a chapter you'd like us to unpack.
See you in the next deep dive.